This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, Chief Investment Officer, and Cameron Passmore, Chief Executive Officer at PWL Capital.
Welcome to episode 374. And Ben, shout out to you for finding another phenomenal guest. This week we head back to the University of Arizona. We had a great chat with Professor David C. Brown. What a fascinating, nice guy. And you see the stylistic commonalities with, his colleague, Scott Cederberg, who is a fan favorite on the pod. And so this week the topic is about glide path and target date funds in retirement accounts, predominantly in the U.S. So it's not as predominant in Canada, but the concept is you have an asset allocation that drifts to become more conservative as you get older. Wow, the stuff that we learned today. I know you've done a lot of research. You have a big head start on me. It is absolutely fascinating. It goes into areas that you never even saw coming, right? So with that, you have to tee this one up.
Yeah, so we talked about David's research on target date funds, which he's spent a lot of time modeling and thinking about and benchmarking. Target date funds are super common in U.S. retirement accounts. A lot of people participate in 401k plans. And as David mentioned, a huge portion of the contributions going into those 401k plans
70%.
Are going into target date funds at this point in time. So they're enormously important to American retirement savers. And Scott's research, just to come back to that, we do discuss that with David in this episode as well. Scott's research basically suggests that target date fund asset allocations that drift toward fixed income over time may be suboptimal, and that you should probably have in Scott's paper, 100% equity allocation all the way through, including right through retirement. So that kind of shows that maybe their asset allocations are suboptimal. And then what David's research shows is, given the asset allocation that a target date fund has, how are they performing? So they built a methodology for benchmarking target date funds that holds their asset allocation and their glide path constant, but asks in very simple terms, how would this glide path have performed if it were simply invested in index funds instead of invested in the actual funds that make up the target date fund? And I don't want to spill the candy in the lobby, as you say, Cameron, but they basically find that target date funds are not performing very well relative to the index fund implementation of the same glide path. And that's a whole other interesting idea. And we talked about the dispersion in target date fund returns as well. But I find it really interesting that if you're in a retirement plan and you're investing in a target date fund, you kind of assume, and I kind of had assumed, because target date funds, as you mentioned, Cameron, they're not as big in Canada. I haven't looked at them much, but I kind of just thought a target date fund is a target date fund. That could not be further from the truth. You can have materially different asset allocation glide paths and materially different returns from one target date fund to another.
And materially different rebalancing. Like this
Also
human
true.
behavior element kicks in when you would think this is like the rules cast in stone type plans.
That's right.
That is not the case necessarily.
Yeah, so they document in some of the research that we talk about that target date funds appear to be tactically deviating from their strategic asset allocation glide paths, which contributes to the dispersion that we see in target date fund returns. It really is wild. So a lot of interesting stuff to think about for anyone who's investing in target date funds, and assuming, like I did, that it's like, they're designed to be the default option. You just kind of assume that it's a target date fund is a target date fund. But I think you have to really look more carefully. And that's part of David's motivation for this research, is to help people, give people the tools to look more carefully at what is actually happening under the hood with their target date fund. Anyway, I think it's a really interesting discussion. I think the research they've done is pretty compelling. We will link to the tool that David and his co-author Sean Davies have built that lets you look under the hood of target date funds, of American target date funds. And lots of lots of good stuff to think about, I think, in this episode. And we have heard from listeners who have, based on Rational Reminder content, gone to their HR department or whatever and have actually successfully argued for changes in their company 401k plan options. So I think this will contribute to that type of discussion.
So David C. Brown is the Associate Professor of Finance at the Eller College of Management at the University of Arizona.
I think that's a pretty good introduction.
And a good guy, very compelling. So, all right, with that, let's go to our conversation with Professor David C. Brown.
David Brown, welcome to the Rational Reminder podcast.
Thank you so much for having me. Really appreciate being here today.
We're excited to be talking to you. To give us some background, can you tell us what a QDIA is?
Yeah, it's a qualified default investment alternative. So what that really means, though, is it can be included on a retirement plan menu as the default. Many people, when they sign up, have no idea what to select. And so you have to give them something. And so that menu is part of the Pension Protection Act of 2006, expanded to include target date funds. So that's a lot of the reason we're talking today is because of that expansion they did in 2006.
Okay. And just to make sure listeners are on the same page, what is a target date fund?
So a target date fund is basically a one-stop shop for investors that are planning for their retirements, right? There are all sorts of different asset classes that investors might want to have as they save for retirement. And a target date fund is designed to do that asset allocation for you. So it'll do your mix of stocks and bonds, and it'll actually change to evolve over time. So if you're retiring in 2060, you can buy a 2060 retirement target date fund to basically fund your retirement. And then every month you're just putting money into that same fund and the fund's taking care of the asset allocation for you.
And how significant are target date fund holdings in American retirement accounts today?
Increasingly more and more so. I think they're about half of retirement accounts now. That's been increasing over time. But I think the big number to look at is on a monthly basis, as people are contributing, over 70% of the money is going into target date funds now. Yeah, it's really significant. And if you look at younger people that started with them as the default options, most, if not all of their assets are in a single target date fund, which is exactly how the product was designed. So it's doing what we wanted it to do. But it also means these target date funds are having an increasingly important space in the retirement landscape.
Can you talk in general terms what like you mentioned that they changed the mix of stocks and bonds over time. What does that glide path typically look like?
The idea of a glide path is that you're going to decrease the amount of risk you take over time. So you might start out, 20 years old in your first job, saving into your retirement plan and almost entirely invested in stock, with this whole idea of stocks for the long run, right? And there's all sorts of life cycle portfolio choice models built around this. And the vast majority of them kind of indicate you should take more risk early on because you have a lot of kind of human capital in your own income you produce. And then as you get older and you have less time to work yourself, you shift into safer assets like bonds. Obviously, there are lots of kind of counterpoints that come in on that, but I think that's the generally accepted wisdom today. And so you're going to see that mechanical decrease in equity exposure or risk as you age and get closer to retirement.
Why is it difficult to benchmark or even compare target date funds?
Because they all do it a little bit differently. Each of the different target date fund providers, and here you think Fidelity, PIMCO, T. Rowe Price, Vanguard, they all have all sorts of different choices they can make, right? One choice is, what does that glide path look like? How much equity do you start with? And then how quickly do you decrease that equity mix over time? So that's going to be one big choice. Another big choice is going to be, well, within the equity bucket, how do you slice that up? Do you do, a mixed domestic and international? And then if you do domestic and international, do you do even more sub-asset classes? So do we start doing, small, medium, large, value and growth all within the US? And then outside the US, start thinking about developed versus emerging markets? Or do we split, developed markets into Asia Pacific and Europe? You can go kind of on and on. And what you'll see is that some fund companies decide to put 30 different mutual funds in their target date fund. Others tend to do 4.
Hmm.
So there's vast diversity in how that is accomplished. And then as one more, how are you going to manage that glide path through retirement? This is one of the classic ones, is the to versus through retirement, because to retirement almost assumes that once you hit, 2060 or, 2025 for those retiring this year, the idea was that you would take your money out. Well, fund managers don't like the idea of losing their assets under management. And so then through retirement plans came out. And so the idea is that they're going to continue managing that asset allocation mix all the way through your retirement. So, you invest in this thing when you're 20 and you hold this thing until you die, basically. That's kind of the asset management industry's plan on it.
Hmm. Yeah, it's really interesting. We don't have a big target date fund market in Canada. It's just not developed in the same way that it has in the States. So I hadn't thought a ton about it, but just the fact that they have different glide paths and the fund companies will even try and differentiate themselves by having a better glide path. It's super, super interesting. Didn't really realize any of that.
Well, and then one other layer is that the fund companies almost exclusively hold their own funds. So it's not
Right.
like Fidelity is looking outside of Fidelity for mutual funds to hold. They're pretty much looking exclusively at Fidelity funds. So is Vanguard, so is PIMCO, so is BlackRock. All the big players do this, and there are very few that will actually deviate and try to
Mm,
pick, the best funds from different fund families. And so as a result, you end up with kind of a beholden fund structure where you have to use Fidelity funds if you're in the Fidelity plan.
right. So how do you approach benchmarking target date funds in your research?
So what we found when we started looking at this is there's no great benchmark. Part of it is because of these different asset allocations, different funds. I mean, I didn't even go into different fee structures, but it all makes it very hard to compare. And so our premise is that, these are funds of funds, right? They're holding other mutual funds in them for the most part. And so what we can do is look at those underlying mutual funds and map them to a set of common assets, right? Again, I mentioned kind of, US equities versus international equities, or large cap versus small cap, right? We have a pretty good way to benchmark those funds, and those are index funds, right? This has been a big part of the literature of comparing active to passive management for a long time. And so our basic idea is if we can take any given fund that a target date fund holds, map it to an index fund that it best replicates, right? We're going to think about replicating funds here. Then we can take those underlying passive index components, build them back up into the same portfolio with the same asset allocation, and now we have a replicating target date fund. So essentially, it's a custom benchmark built to each individual TDF if you were to make that TDF as a passive product.
Yeah, okay, interesting. So it's taking the glide path of the asset allocation as sort of given and then comparing the underlying funds to index funds rolled up to the asset allocation.
Yeah, exactly. You could think about it as measuring kind of the operational efficiency of the target date fund, right? We're taking the glide path as given, and we can talk more about that as we keep going, because that necessarily means that some of the value that these TDF managers are adding, we're not giving them credit for here.
Right.
We're
Yeah.
just saying, given that you picked your asset allocation, how well did you basically deliver on it
Yeah.
relative to what you could do with a very cheap passive product?
Right.
Right. Yeah, makes sense. How confident are you that the replicating ETFs that you're choosing or index funds that you're choosing are actually good representations of the underlying asset class funds in the target date funds?
Overall, I'm very confident
Hmm.
at the TDF level. And that's because we can run, regressions and correlations and look at how well do those replicating fund returns match the TDF returns. And on average, it's 99.7% kind of match. Oftentimes it's 99.9, but we do get situations where the match is not great, right? You could think about, for example, a commodities fund. In our first iteration, kind of our baseline specification in the paper, we match all the underlying funds to a set of Vanguard index funds and ETFs. So we use both index funds and ETFs. That way we show it can work either way, but it's really just 50 funds. And in that mix, Vanguard did not have a commodity fund at the time. And so as a result, you can get a commodity fund that Fidelity is offering that really doesn't match very well to anything. This example, I think we had like a 60% correlation, or a 0.6 correlation rather. And so the match is not great. However, commodities are usually a very slice of the portfolio. So when you aggregate that up, really it kind of washes out at the end of the day. Now, that's not a perfect answer. So what we actually do as kind of an extension is we say, let's just take the entire ETF universe. Say that you could use any ETF to match this to, because there's pretty much an ETF for any asset class. We get much better individual matches, and the overall results of the paper do not change at all. So at the end of the day, we don't think it's something that matters significantly as we get the whole feeling of the industry.
How much tracking error do your replicating funds have relative to the target date funds?
Like I said, for the most part, it's very, very minimal, right? These things are tracking 99.9%, 99.7%. We do see some interesting differences come up, though, that we had to address in the research. One of those is that when you build up a replicating fund, you're not going to have the same cash drag that a target date portfolio has to deal with, right? Just the fact that they have money flowing in and out through redemptions and new money coming in, they have to keep some cash on hand to manage that. Oftentimes it's 2 or 3% of the portfolio. And so if we don't replicate that cash piece, then we're going to actually have better returns when markets are up, right? You just have more risk exposure and less when markets are down. So we get basically a little bit more beta in ours than we would get otherwise. But again, we can adjust for that when we're doing the analysis.
Okay. And do you adjust for that? Like, do you add a cash allocation?
So we do two different types of analysis here. One, we do it with the replicating funds, and there we don't add the cash piece. But we also do the more traditional beta and alpha type asset pricing analysis, and that's where we account for it with that beta piece.
Okay, got it. So
yeah.
How do the target date funds perform relative to the replicating benchmarks?
So on average, and this is all in the original paper we wrote that ended in 2019 for our sample. It was about 1% per year is how much they underperform these replicating fund benchmarks. And 1% a year, I think most of the listeners here understand that that's a big deal, but especially it's a big deal when you're thinking about retirement horizons, right? If you're 40 years out from retirement and you're thinking about maybe 20 or 30 years in retirement, 1% a year for 60 or 70 years is half your money. So it's a really significant amount that we're talking about here.
And what are the main drivers of this underperformance?
So there are two big drivers and one small driver. The biggest driver is fees. So there's no surprise here. For that 1%, about 55 basis points of that is higher fees on the TDFs. And these are incremental fees. So the replicating fund itself has index fund fees built into it. So it's fees over and above that. And those are really coming from two sources. One is the underlying mutual funds. Many times they are active, and so they're just going to have higher fees. And so just focusing on the fee piece is going to pick that up. The other piece is TDF level fees. So these are funds of funds. And so the TDF will also charge a fee on top of the underlying funds management fee. Now, that's not always the case. Some funds will charge no TDF fee. Some will charge no fee on the underlying assets, so they'll use zero cost share classes. And that's another way that I think the TDF companies play this game a little bit of how they present their fees. But at the end of the day, 55 basis points is from that fee piece. Now, the other 45 basis points, that's coming from poor active management. So if we just look at gross returns, so take the fees out of it now, the active funds underperform those passive benchmarks by that 45 basis points on average per year, right? Again, and that's before fees. We want to find active managers that are actually at least breaking even and covering their expenses, but those are not the funds that have traditionally been placed in target date funds.
Wild. So they're underperforming gross of fees and then obviously even more so net of fees.
Exactly. And then there's a small third piece that is timing. So when we're doing our analysis, this is all based on the holdings that the funds report. So the TDF reports their holdings at the end of each quarter. And so what they do between the quarter, we can't really see. They're making, tactical asset allocation decisions. They're rebalancing. And so ultimately we have to choose a benchmark here, and we choose to rebalance monthly. And we're going to update the holdings quarterly. So to the extent that they're rebalancing differently than that, and they're also making shifts in the asset allocation that we don't see, that can either add or subtract value as well. And on average, that's about a couple basis points per year. So not really significant one way or the other.
Okay, makes sense. Yeah, so it's really the underperformance of active and then add on the higher fees.
Exactly.
Not surprising, I guess, but not good news for target date fund investors. How have those costs evolved, or how do they evolve over your sample period? Like, are
Yeah.
costs getting lower, or is it improving?
So there is some good news there. I guess there's good news and bad news. So the good news is that the costs of TDFs have come down quite a bit over time, just like we've seen in the passive fund space and the active fund space for that matter. So whereas on average, I think the average fee a decade ago was like 60 basis points ish. Now it's down into the 40 basis points range. So it's certainly improving. However, it's not necessarily all getting better. So we don't have a current number on the recent decade, just since we haven't updated the academic paper. But this actually brings me to something that my co-author and I have done, and that's that we think it's really important for investors to have access to this kind of data on their fund, right? As academics, we do research with data that we all kind of get from a university license, and we can't take that data and put it on a website somewhere. So my partner and I, Sean Davies is my co-author at Colorado. We actually started a company where we're able to buy the data to provide it to people. So
wow.
the website is glidepathfinancial.com, but you can go there and basically look up whatever your TDF is and see how it's performed over the last 5 years. And so good news again is that a lot of funds are doing well, and generally that spread has come down. The bad news is there's still huge disparity between the best and worst performers, right? If you look at, BlackRock over the last few years has done really well, and oftentimes they'll beat their benchmark by sometimes more than 1%. And on the flip side, we have, T. Rowe or American funds that are lagging it by more than 1%. So you can see, 3% difference in kind of relative performance from the best to the worst performers, which, we talked about 1% being big, 3% is massive.
Wow.
That's nuts. So there's significant, like very, very significant dispersion between the best and, like, given a retirement date, if I understand correctly, the best and worst target date fund performance is like materially different.
Yeah. And actually, I'm going to go back to a paper by Balduzzi and Reuter. They have a 2019 paper in the RFS that looked at this, kind of first documented how much dispersion there was. And obviously this is cherry picked, but there was 1 month in which, if you compared TDFs within a given vintage, the difference in the monthly return, right? 1 month return between the best and worst performers was 23%. Like,
yeah, that's nuts.
Dumbfoundingly huge. But because they're taking, again, so many different kinds of bets in different ways, there's a lot of scope for this dispersion and performance that really hasn't gone away over time.
Wild, yeah. So that's like a whole other risk for target date fund investors. It's like, on average, you've got the drag, but you could end up in one of the worst performing target date funds, or I guess one of the best ones.
Right. And, I was mentioning some companies here. When we wrote the original paper, Fidelity, they were kind of an underperformer by about 1% per year. If you look in the last 5 years, they're overperforming by about 0.5% per year. And again, this is kind of averaged over vintages, and again, different time periods. Fidelity is a fairly active shop, and that's where a lot of their kind of outperformance is showing up. So for a good period of time, they underperformed. Now they seem to be overperforming based on this type of benchmarking. Now, what are they going to do for the next 60 years? Who knows? But that kind of volatility is something that you're going to get when you have more of this active management.
Right.
And do you find any evidence that the plan sponsors or investors are aware of how their target date funds are actually doing?
Not really.
Wow.
So the way we approach this is to look at fund flows, or the assets under management. This is a traditional approach in the academic literature that we can say, when a fund does better, it tends to attract more inflows. More people want to invest with a manager who's producing alpha. And so we can say, all right, when the TDFs do better, based on this measure relative to this benchmark, do they attract more money, or do they lose more money when they do worse? And generally, there's no sensitivity to it from investors. And investors, I think you hit on this, Cameron, but it's not really the investors that always have the choice, right? You're in a 401k plan where most of these assets are, you really only have access to one TDF, right? You might have access to different vintages, so you can pick whether you're in the 2025, 2030, 2040, et cetera, but you're not going to have a Fidelity and a Vanguard product right next to each other, at least not very often. And so if you're going to change, it's usually somebody in your HR department that has to start that process going forward, or a plan sponsor that's going to go ahead and say, okay, we're going to shift everyone from, sponsor X or plan X to plan Y. So even there, though, we don't see a lot of evidence that those big shifts are happening in response to this performance.
Interesting. So yeah, it's not the individuals, it's the plan sponsor that have to make the change, but it doesn't seem like they're following your benchmarking methodology to say, hey, maybe we should change fund providers.
And I think a lot of that's because this is not trivial analysis to put together.
Right.
Right. It takes a bunch of academic analysis to be able to understand how should we construct these portfolios, actually do it, and then, like I said, try to make it available so people can make decisions off of it. Right. We too often in academia, we're very much in our ivory tower of let's figure it out, and then we'll tell the other academics about it through our finance journals. But we need ways to disseminate it and push it out to practitioners who can make decisions based on this data now. And so that's why we have our website.
Okay, so I want to come back to the benchmarking methodology and how it holds the glide path constant. What do you think about the argument that an actively managed fund family, like say it's Fidelity or whatever, with a better glide path? I was actually reading some Fidelity TDF literature recently, and they talk about their belief that they should have investors should have higher allocations to equities. Mm-hmm. So Fidelity says, okay, we need a higher equity allocation. So, and I know you said that they're outperforming based on your methodology, but even if they're underperforming relative to an asset allocation held constant benchmark, they might be outperforming relative to a more conservative target date fund. So, like, how do you think about that?
So I think the first step is that we don't have to think about active glide paths as necessarily being active underlying funds. Right? Fidelity offers a number of products. And so you could go to Fidelity and use their Fidelity Freedom Index product, which is going to be just index funds. So you can go Fidelity Freedom, which is the active funds, or you can go Fidelity Freedom Balanced, which is going to be a mix of the two. So you can make these two decisions independently, basically. You can kind of pick your risk level through the fund family and then pick whether you want the active or passive implementation of that glide path. So it's not really a fair choice to say those are necessarily coupled. That said, it could be that active fund managers, some TDFs are actually more active in managing their glide paths than others. And we'll get to that in a minute. So the other big consideration is that we really don't know what an optimal glide path looks like. In the academic literature, there, again, this general consensus that it should be downward sloping, so less risk over time. But some people have proposed it could actually be upward sloping. And one of my colleagues here at the University of Arizona, who's been on your show recently, argues for essentially an all equity retirement portfolio split between domestic and international funds because of some long-term return properties. And it's a fascinating paper by Scott Cederberg and co-authors. But essentially, the jury's still out on what the optimal glide path is. And so while you might think you want a riskier glide path, sure, you can go for that. You can clearly see some are going to have more risk than others. But again, I think that can be separated out from how active your manager is at the end of the day.
Yeah. Okay. Interesting. So, and this is, like you said, we don't know what the optimal glide path is. So it's a bit of a tricky question to ask. But if we believe that a higher equity allocation is good, as Fidelity suggests it is, and as Scott Cederberg's research suggests that it is, what do you think about the argument that the active management in Fidelity's active target date fund actually allows the plan participants to feel more comfortable with a higher equity allocation? It's kind of like the Money Doctors paper in Journal of Finance, where if the end investors trust, even if it's not working, the end investors trust that the active managers are doing something good for them, that allows them to take more equity risk, and that's net a good thing. What do you think about that?
I mean, I think there's definitely something to be said for that. I think there are all sorts of behavioral considerations that have to be accounted for when thinking about target date funds, because these are people making real decisions, not in a vacuum of, an academic model. That said, I think with, the Money Doctor's perspective, the assumption is you're working with somebody that you can trust, right? And you can develop that relationship. In these cases, somebody's picking a plan off of a menu in a 401k, and they have no idea whether there's a person doing anything in the background there. So I'm not sure how much it really matters in this setting. There's a small slice of investors who access TDFs directly through a financial advisor. But if you're going through a financial advisor, odds are that they're going to be more actively managing your portfolio, or at least managing the asset allocation more than just putting you in a plain vanilla TDF.
Right.
They could. Hopefully, they're not charging you too much if that's the piece they're doing there.
Yeah, no, makes sense. I'm not. I don't love that argument about active management allowing people to take more equity risk. Like we on this podcast typically advocate for index funds, but it is a comment that I've heard with respect to target date funds. Like, yeah, active management might underperform, but it's going to let people feel more comfortable with more equity risk. Therefore, it could be actually a good thing. But anyway, your comments made a lot of sense.
So in designing an alternative solution, how would you address the dispersion in glide paths across TDF fund families?
Right. So you have all these different TDF families that have, big research teams that they've employed to design these optimal glide paths. And so we have a lot of different people arguing over this. And it's fascinating how distinct these glide paths can be. Again, they're generally downward sloping, but they change frequently and they can have very different slopes and they're all over the place. And so my perspective on this is we have a bunch of people. Let's use the wisdom of the crowds. This has come up in lots of other contexts and shown to work well. So essentially, if you take the industry aggregate asset allocation and use that as a way to drive a TDF, I think that could actually be a very valuable product. And that essentially you're indexing the indexers almost. And you're taking the index fund idea to an asset allocation level rather than to an individual asset class level, which has been kind of what's been very successful up to this point.
That's a super interesting idea. Do you asset weight that or just equal weight the allocations of other target date funds?
I think there are a lot of questions on how you want to do it.
Okay.
I mean, the first level question is, do you give Vanguard 40% of the weight? Right? Vanguard is a very particular asset allocation. They use 4 to 6 funds rather than many of the sub-asset allocations. So again, they're just going to be very high level. They have 40% of the assets. They're generally on the conservative side. And so I think that's where, actually some careful thought can be put into it. And we actually might see multiple index providers come out with something like this that all have a different flavor to them. Because the other big question is, how quickly do you react to the industry? Because like we'll talk about in a minute, some of these funds are changing their glide paths very frequently. And do you necessarily want to be chasing these quick changes in asset allocation if you're more of a stable long-term index type idea?
Yeah, especially given that those tactical changes are not doing so hot, which we'll talk about now. So yeah, can you keep going on? How often do target date funds tactically deviate from their glide path designs?
Yeah, so before I get too deep in this, I want to talk about the glide path design and what we can do and what we can't do. So, glide paths are something that we can observe from time to time. That's essentially what we do. Each quarter, we see the asset allocation, and we see it across different vintages within a TDF series. So, right, a TDF series will have a 2025, a 2030, a 2035, all the way out to 2070. And I think there might be a 2075 on the market now, but there aren't many of them. And so you can essentially piece together the glide path by seeing how that asset allocation changes at one point in time across the different vintages. Now, is that their intended glide path? Not necessarily. They oftentimes put a graph in their prospectus that comes out once a year that kind of shows, here's our glide path. But they also say, we can deviate from that. And oftentimes that picture doesn't change much from year to year, even if their asset allocation did change from year to year. So what they're intending to do in their glide path is very different than what we can capture. What we can capture is just, how did the asset allocation change? And so when we look at how did the asset allocation change, and we can do that relative to kind of how we expected it to evolve along the glide path, we see that from one quarter to the next, they're changing their glide paths by about 4%. Now, what that means is, say you just had a 2-asset portfolio, stocks and bonds, 50-50. That means by the end of the quarter, you've gone to 54-46. So that's a pretty big shift. And if you go out a year from that initial point where you measured it, now it's 9%. So very big swings in the glide path, again, on average, over either one quarter or over the course of a year.
How do you measure the intended glide path of a fund family?
So again, that's what's really hard to understand, is what is the strategic glide path versus the tactical glide path, right? Or the strategic asset allocation versus tactical asset allocation. Strategic generally is thought of as these long-term shifts of, okay, we've done a bunch of research and we've decided that we do want to increase the overall equity exposure. This happened with Vanguard. I think it was back in 2016, but they made a big strategic shift and all of their glide paths kind of shifted up essentially. Versus tactical changes are, ooh, our capital market assumptions have changed for this year. We really think
Right.
US equity is going to outperform international equity. And so we're going to switch and up US by 5% and decrease international by 5%. That'd be more of a tactical change. And so the problem is, as researchers, we can't get in the TDF managers' heads, and they don't put out press releases that say exactly what they're thinking when they make these changes. So I think it's really important to note that we are not capturing the intent really at all.
Hmm.
It's just when they made changes, did those changes end up to be good moves or not? That's kind of the analysis that we can do.
Man, okay. So you're like estimating what their intended glide path was, but you don't actually know what it was, right?
Exactly.
And then you're measuring whether they deviated from what you are estimating their strategic asset allocation to be.
Right. And so it's a couple layers here. But the basic idea is that we know the glide path is downward sloping, right? We can see how it changes from 2025 to 2030.
Right.
And so as we go from 2025 to 2026, we can expect a little bit of that drift to be incorporated into their asset allocation over time, right? We expect equity to go down a bit, almost zero if it's a long out retirement vintage like 2060s. If it's 2025, we expect a more significant decrease in equity. And so then we can say, okay, we expected equity to go from 50 to 49%. What actually happened? And that's really where this kind of next level of research goes, is to say, how much was that change? What direction was it? And did it actually lead to better returns or not?
What effect are increasingly active tactical glide path changes having on the target date fund returns?
So on average, not a good effect. These are not huge effects, right? In the last paper, we were talking about 1% per year. We find about a 10 basis point effect here. So on average, because they're changing their glide path, it's hurting returns by about 10 basis points. Again, not huge, but when you think about Vanguard, 10 basis points is about what their fee is. And if all of a sudden you're layering an extra cost on top of investors by essentially being active when you didn't have to be, right?
Right.
These managers could have essentially said, hey, here's our glide path. We're going to stick to it. And they would have done better, right? That's the overall industry picture. That's not true for every manager, right, at every point in time, but that's what we've seen on average over the last 20 years or so.
So are the managers, they're not saying that they're doing this, right? If I understand correctly, because you're estimating what the intended glide path was and then measuring deviations from that. But the managers aren't, like Fidelity's not coming out and saying we're overweight, whatever in our asset allocation this year.
Certainly not with the target date funds. I think, again, you get some of this discussion when they talk about their capital market assumptions, and that's more, fund families overall putting these kind of assumptions out there, but you don't see it in a narrative from the target date fund managers. And so it is a question of, I still wonder exactly why they're doing this. And some of the managers, you get a chance to talk to them, and they have convictions around those capital market assumptions, and they really believe that they know what they're doing and that this is going to better position their investors. I've never gotten a sense that anybody is trying to do this against their investors. Everybody's trying to help the investors and get them better returns and get them successfully to retirement. So all the good intentions in the world are there. On average, the industry just doesn't seem to be delivering where they think they can.
Man, so why are they still doing it if it's leading to underperformance?
I think this comes back a little bit to we were talking about behavioral things earlier, right? We are people, right? And, one of the biggest things we see is that the underperformance from being active tends to concentrate when people chase returns, right? So I see that equity has overperformed in the last quarter, and rather than rebalancing, right, back towards kind of my intended or, my previous glide path at least, instead, I end up chasing that and saying, okay, just again, as an example to make things concrete, you're 50-50 to start the quarter, and equity outperforms bonds. So maybe you end up just because of returns at 52-48, right? The rebalancing would have you go back to 50-50 and maybe actually decrease equity slightly to follow that glide path. Instead, a lot of these fund companies are actually chasing and saying, well, let's go 54% equity next quarter. And You know, to an extent, there is a momentum effect, right? So they might be trying to pick that up, but they don't seem to be doing it successfully over time.
Not doing this. I think, like, I don't think people using target date funds realize that this is happening. Does that
No,
make
not at
sense?
all.
Yeah. Okay.
Whenever I present this paper, people are generally shocked that there's that much change in the glide path because glide paths are thought of as very stable,
Right.
right? We're just basically giving you this asset allocation and making small tweaks per quarter. But, when you actually kind of go to implement these things, there are all sorts of money flowing in. There's all sorts of money flowing out, depending on which vintage you're in. And as a result, there's a lot of management that has to happen to keep that glide path kind of where you want it to be. And,
Wow.
returns are going to be different across asset classes. So you do have to think, how are we going to rebalance? And that's a very active choice in managing the fund. So with all that, I think it introduces scope to make these other changes as well.
So it's really hard to keep the human bias out of this systematic platform.
Yeah, especially when you're getting paid to manage the fund and the
Amazing.
pressure to, come up with your best ideas and put them into the fund, even though those best ideas might be really hard. I mean, predicting macroeconomic trends is not easy, right? There's a ton of, active managers picking stocks is hard. I think it's generally accepted it's even harder to pick macro moves.
So how do you know you're not just observing incomplete rebalancing at your sampling intervals?
So again, we only observe quarterly, so we can't fully rule out rebalancing. This is the academic in me. Um, However, what we can show is that, look at people making that move from 52 to from 50 to 52% because of returns.
Yeah.
We can ask what percentage of the time do they actually continue on and chase the return versus rebalance it? 38% of the time, people are actually going to chase that return. About 24% of the time, they're in the middle, and the rest, they're actually going rebalancing the other direction. So essentially, we can show how often people are chasing returns, and we're pretty confident that most of it is not driven by kind of a lack of full rebalancing.
Hmm.
And you can actually see big patterns across different fund companies, right? Vanguard, they almost entirely rebalance every quarter. Companies like, I think American Funds is another that rebalances most of the time. Whereas, JP Morgan or Fidelity, they tend to be much more active and more likely to be in that return chasing category.
That's really interesting. It's really interesting that it shows up by fund grouping like that. So what's your big picture main conclusion on how these tactical glide path changes are affecting target date fund performance?
For right now, it's not good. It's that when fund managers are active, they are doing so to the detriment of investors,
Hmm.
right? It would be better if the whole industry decided to just kind of set the glide path and implement it rather than making these tweaks. Now, does that mean they shouldn't have researchers working on this and trying to figure out better glide paths? No, but I think there should be some tempering of how aggressive they are in making these changes.
Hmm.
Another stat that I find kind of crazy is that in any given quarter, 40% of TDFs either add or delete a fund holding, right?
Hmm.
So they're taking a fund out and replacing it with something. Maybe it's large cap for another large cap, or it could be that large caps switching out for, a bond fund. But the fact that they're switching out that frequently tells me, we should all just say, hey, it's okay to not do too much, right? Maybe it should just be a mantra in the industry for a little while. And hopefully investors will do a little bit better because of a lack of activity.
Hmm.
Wow. That's amazing. Okay, our final few questions for you. So based on all your research, what are your views on the state of target date funds?
So I want to start out by saying I am a big proponent of target date funds, right? When the QDIA, when they became a QDIA in 2006, what they replaced were basically money market funds. So 20 years ago, investors, if they didn't pick any other asset allocation, would just have their money in cash, right? They would earn very little, no stock market exposure, not going to set you up for a very good retirement. So shifting to TDFs has been a massive positive improvement for investors. I think there are huge trends in the industry that are decreasing the costs, and there are more and more really great products out there for people to use. That all said, there's this huge dispersion, so there's still a lot we can do to make TDFs better. And that's what I view as kind of my role as an academic, is to help people understand, one, there is this dispersion, But two, there are ways to find out whether your fund is performing well or poorly. And then you can make a change based on that. So really, again, my co-author and I want to get our data out there. That way people can make better, more informed decisions. You guys mentioned that it's less of an issue in Canada, and I think similarly in Europe. But I talked to a provider earlier this week that's actually launching indexes in Europe for TDFs. So these are products that are coming out soon, and I think TDFs are going to start bleeding into other spaces as well, making them even more important for us to understand well, and hopefully to make people understand and see exactly what's going on in them.
I want to come back to something we talked about earlier, just about the differences in glide paths. So if someone goes to the website that you've created and finds a fund that's underperforming its asset allocation matched benchmark, if they go and ditch that fund for one that has performed better, but they end up with a more conservative overall portfolio, is that good or bad?
Good question. I'm not going to say it's necessarily good or bad. It depends on what market returns are over the next however many years, right?
Right.
I'd expect them to generally be positive. Markets go up over time for the most part. But I think my big question would be, are they going to know which one's going to be riskier or not? Right. I mean, and this is a weakness in the data that we have out there so far. Right now, we are benchmarking to that replicating fund without considering the total risk level. This is something we've realized, and so we're working on developing some new tools. They're really aimed more at plan sponsors and consultants in the industry, or people that are trying to provide advice on TDFs, to really give you a deep understanding of the asset allocation behind each TDF, how that's evolved, and essentially do risk-adjusted benchmarks in addition to the benchmarking that we've done and talked about today. So I think that's where we're going with the website. We're not there yet, but I think that would be my big thing, is say, hey, if you can isolate on risk level, so if you have the risk level you like, now pick the thing that's performing best within that risk level. And so I think that's a really good question from your perspective, to say, let's think about risk level first before we necessarily hone in on how operationally effective you are.
Yeah. That would be super valuable if you could hold the risk level constant, then you could find the most efficient fund at that asset allocation. Super interesting. Okay. So safe to say though, you still think target date funds are definitely a net benefit to investors because it's much better than sitting in cash.
Yep.
But some work to be done, potentially, including work to be done on the ability to analyze and compare funds, even beyond what you've done so far.
Exactly, because you do want to do that risk-based adjustment, so and then you can start putting yourself into the right category. Right? I mean, there's a whole other question of, do you know how to put yourself into the right risk category of a TDF?
Yeah.
Right. And so, I mean, that's a big struggle with the industry. And I think, at the end of the day, that comes down to better education, which lots of people are pushing for in this space. So hopefully, this can become part of that education as well.
So I've got to ask, since you brought it up earlier, what are your views? You've done all this work on target date funds. You've been talking to plan sponsors. What are your views on the Scott Cederberg 100% equity lifecycle portfolio research?
So I think it's phenomenal research that Scott's done. Scott and Mike and Ijan all together. Personally, I have moved more of my portfolio that direction. I think so in full disclosure, I am, much more into the basically half and half US and international equity now. I used to have a bigger bond position. I've followed their advice. Part of the reason I've done that is I think I have the stomach to handle downturns. Yep. Because I think the biggest problem is the behavioral side. If you're going to be all equity invested, and we have some big global event like the global financial crisis happen again, it's going to be okay if you can withstand it and you're not going to sell at the bottom. But time after time, studies have shown that people do. Right. I feel that I'm in a very fortunate position. I'm tenured here at the University of Arizona. My income stream is pretty comfortable. I've amassed a decent amount of savings to where if it got cut in half, I'm not going to freak out, I think, right? Maybe I would, and maybe I'd regret everything I'm saying. But because of that, I think you can invest more aggressively. Now, is that better for everybody? I'm less convinced, and especially when people can pull the trigger themselves to take money out. Studies have shown that investors are less likely to take money out of a TDF to sell it and move to something else because they're in a TDF versus other assets. So that's good. People are doing this less. But would that effect go away if we kind of went to these all equity portfolios? So especially if there's a bunch of people that are having not the all equity portfolios, right? Because if you see, you know, my buddy down the hall, his fund only went down 20% and mine went down 40. Now you're going to have even more bad feelings around it. And so I think dealing with these behavioral concerns are paramount to figuring out how to get people better portfolios for the long run. Because I do believe if you can maintain it, I mean, the data shows over a huge sample of, places and time that that works. Now, holding the portfolio is a whole nother thing, though.
Yeah. Yeah. I think the behavioral thing is a big piece of that for sure. I've seen, you mentioned it, but I've seen literature from a couple of different record keepers, like from Fidelity and I think T. Rowe Price, showing the data that you mentioned, where they have the plan participants changing their asset allocations.
Mm-hmm.
The incidence of that happening is much higher for people who don't have 100% of their portfolio in a target date fund. And it's minimal, like almost zero. And we can put one of these charts in the video for people who have 100% of their savings in target date funds. So it is pretty interesting to see that. And I think it's a really interesting question to think about. Would that change if the target date funds were 100% equity portfolios instead of whatever their current allocation is?
Right. I mean, my gut would say no, because most people aren't thinking about this decision, right? They're getting into the default and they're sticking with it. They're not going to really question it. It's the people that are paying attention that then log in and see how they've done poorly and then decide to make a change, right? So it's one of those, if you could just commit to not looking at your account for a decade, you would probably be better off. And I think there actually might be scope for that in the future, of providers creating products that people just can't touch. Right.
There's like a lockbox. Yeah.
Yeah, exactly. I mean, these happen in, private equity, and we're talking all about making private equity public now. Maybe we should be thinking about the features of private equity that we can just put on public equity to make it work better for the investors and prevent these behavioral mistakes that, happen time after time after time and are probably going to keep happening.
Maybe that would break the expected returns, though. Like, I think with one of the early criticisms of Scott's paper, and they took it out of their paper entirely, I think, was the equilibrium effect of, if everybody did this, then the result would not hold. And I think for the behavioral reasons that you outlined, that's probably not a risk. But if we created private equity like lockboxes where people could take public equity risk without feeling like they're actually taking it, that might have more significant equilibrium consequences.
Well, it might get to the money doctors, right? In a sense that people can feel like they can take more risk if they know they're not going to hurt themselves on the back end. But yeah,
isn't that interesting?
I think to your point, the equilibrium consequences, like, Scott's paper essentially goes to, would there be a bond market?
Right.
Right now, there's a huge bond market. I don't think it's going away tomorrow. So.
Wow. Yeah. For the behavioral reasons, I don't think it's going away. Like, I've asked a bunch of our portfolio managers at PWL, just because they're familiar with Scott's research. They've listened to him on our podcast. They've heard me talk about his paper. I asked them recently, all of them, why are your clients not in 100% equity portfolios? Like, what that research says. And I got a bunch of really interesting answers, but a lot of them were focused on that behavioral component. Like, yeah, we know what the research says. The client knows what it says, but they still don't want to be in a really volatile portfolio, even if they understand that in the long run, bonds might have their own unique risks and maybe even be a little bit riskier. They still don't want to see that volatility in their account. It helps them sleep at night. So I think it's hard to make that go away.
Right. Unless we don't look at it.
Yeah, that's true.
So after all said and done, what do you hope that individuals and plan sponsors will do with the great research you've done?
Use it to make better decisions, right? Our whole goal is to make the industry more transparent. So if we can give people the tools to make better decisions through, both understand the operational efficiency of TDFs, understanding where they're taking the risk and how that compares to other TDFs that are out there, and then ultimately get into better products. Because we do see such dispersion. I mean, there are still S&P 500 index funds out there that are charging more than 1% per year that still have assets under management, right? It's all about education and transparency to get people away from these funds that are just too expensive. And so we hope that our research are going to drive people towards that and ultimately make the whole TDF industry better. And, hopefully retirement investors are better off in 30 years thanks to the research we've done.
Yeah, that's a good answer. On the on the not looking at a thing, we had a past guest. I can't remember who it was. I want to say it was Robert Merton, who talked about focusing on payoffs. So instead of focusing on what is the present value, what is the mark-to-market value of the asset, you can focus on what is the expected future payoff. I think John Cochran talks about that in his paper on portfolios for long-term investors too, where he talks about like the inflation index perpetuity is risk-free for the investor, but it's going to be super volatile. But if you focus on the payoff, you focus on the whatever the annuity payment it's going to give you, it feels risk-free. So I wonder if I think making public equities illiquid or locking them up or whatever, I don't think people would do that. I think it would end up being like annuities where nobody wants to buy them because you're giving up control or whatever. But I wonder if there's an opportunity for providers or even wealth management firms like PWL to show the expected retirement cash flow stream and how that changes over time instead of showing the mark-to-market value of the asset. And maybe that helps people stay invested.
Yeah, I think that's a great idea. And I mean, more behavioral research needs to be done, and also, think about the policy implications and whether you can get people to go this direction, right? Ultimately, we got to get people to do it, and whether that's through regulatory channels or actually just seeing that the market shows that people want these products better, right, and they want this view better. I mean, we've gone to a world where, people are looking at their accounts through Robinhood and day trading, single day options and this kind of thing. So we've gone the other direction. Maybe we can start working our way back. But it's a tough thing to do in an era where, investing's basically been gamified for better or for worse.
Yeah, you're right. Things are going in the wrong direction, and technology is pushing things in the wrong direction. That's a tough one to reverse, I think. And even if, like, we do tell her, and it's interesting to think about. We do tell our clients what their expected retirement income is and how that might change if the market goes up or down, or if bond values go up or down or whatever. And we update our expected returns semi-annually. So we have pretty good information to our clients about this is how much you can spend in retirement, which is really what people care about. Mm-hmm. But they still want to know what the mark-to-market value of their assets are. And like, I just don't know if you can make that piece go away.
Yeah, I think that's a fair point. People want to know what they're worth right now. And the more you're thinking about it and planning for it, the more you start paying attention to it, especially as you get older and you get to those periods where you really don't want to, sell right before you hit retirement when you get a big downturn. So yeah, it's a hard problem to solve. And I think that's why we don't have a solution for it yet.
Yeah, super hard. It's tough. You can't go to a client and say, no, everything's fine. The expected returns went up. It's like they don't they don't hear that.
Right, double down. Let's mortgage your house again.
Okay, second to last question here, and a bit of a change of pace. What can you tell us about the Microsoft Excel Collegiate Challenge?
All right, thanks for bringing it up, Ben. I just talked about gamifying investing. I don't love that. What I do like is kind of my other project I've been working on really for the last 4 years is gamifying Excel, right? So Microsoft Excel. I don't know if you guys have seen Excel esports. Have you guys seen that on ESPN showing up occasionally? Yeah. So it's a new thing. Essentially, I am the founder of the Microsoft Excel Collegiate Challenge. There's also a pro competition. And so the program that I founded is really all about providing education for students to get them ready for their careers. I teach financial modeling here at the University of Arizona. So it's naturally kind of a finance plus Excel class. But in so many other classes, even across the finance department, it's hard to get real world skills that these students need when they graduate into the classroom, right? I need to cover Black-Scholes in the options class. I don't have time to show them how to build a binomial tree efficiently in Excel. Like anybody can do it cell by cell, but can you do it in a very efficient way that saves you time and lets you focus more on the analysis and the thinking part? And so that's what the Microsoft Excel Collegiate Challenge is all about, is gamifying Excel, giving students a way to engage with really just fun, creative problem-solving challenges. That way they're building up their resumes at the same time as having fun. So we currently have over 12,000 participants around the world.
Wow.
We have big finals event in Las Vegas. It'll be again on ESPN this year. So we're really excited to see lots of teams there. We have a couple Canadian teams. I don't know if anybody's planned to make the trip down to Vegas yet, but anybody that's out there that is at a school, wants to have a team come, please reach out and we'll get you guys involved.
That is like the nerdiest thing ever, and I absolutely love it.
And you're here for it, yeah. It's very cool.
Hey, it's even nerdier when you put the jersey on. So Send me your sizes and we can get you guys some jerseys.
That's so funny.
Oh, man.
Our last question, David. How do you define success in your life?
So I thought a lot about this one because you guys always ask the question. And I feel very, very fortunate to be where I'm at. In a sense, I feel like I have the greatest job in the world for me. I get to work on what I want to work on when I want to work on it. I was fortunate enough to have gotten tenure a few years ago. That's when I started the Microsoft Excel Collegiate Challenge. And so really, I feel like I've achieved success. But going forward, it's all about balance at the end of the day, right? Because I've got a lot of different opportunities, things to work on. I want to make TDF investors better off. I want to do more research just to understand it. I want to make students better off. And so as long as I'm balancing how I'm kind of adding value to the world, then I think I'm succeeding. And the part that I'm really working on more is balancing my own kind of personal interests outside of work, so to speak, right? I've actually been able to play more tennis and more rock climbing over the last year because I'm a little bit more focused on balance than I have been in the past. So I think if you ask me in a year or two if I've done a good job of balancing all my interests, that'll be my measure of success going forward.
Great answer. David, this has been a great conversation. We really appreciate you coming on the podcast.
Thank you guys very much. Really appreciate it. And, check out our website so you know whether your TDF's doing well.
Yes, we will link that in the episode description so people can check it out. I have used it. It's a really interesting site to explore.
Awesome, David. Great to meet you. Thanks for coming.
Thank you guys very much.